There are fewer than 25 world-class market technicians roaming North America, and you're in for a treat because one of them is with us. Chad Karnes, he's a chief market strategist at ETFguide.com. He is a certified market technician, and he is on our broadcast, and we're glad to have him with us. Chad, welcome to the Index Investing Show. Always great to catch up with you.
Hey, Ron. Thanks for having me back.
Let's talk about the S&P 500, which has gone 42 days without a 1% daily change in either direction. That's the second longest streak in 15 years, and really a testament to the ultra-low volatility environment that the stock market's currently in. So my question, is this the new normal of permanently low volatility in stocks, or is it the quiet before the storm?
Wow. So you said 42 days without a 1% daily change. That's just incredible.
It is.
Yeah, these kinds of ratios and stats, frankly, they're not surprising me anymore, because whether it's this or the percent that the market is above its 200-day moving average, or the time it's been since a 20% market pullback, or even the number of days the market has spent above its 150-day moving average. Frankly, all these stats, they just keep breaking records, and it just seems like we are at some sort of extreme here. So to answer your question, I think it is. I think it is the calm before the storm, and the reason is that if there's one thing that we can count on in the stock market or pretty much in any market, is that they are cyclical. They tend to mean revert, and right now I think that what that means is the low VIX and the low volatility, it won't last forever, and that's something that we can count on. Adding to that statistic, something I recently looked at with my subscribers is that the month of June, the average day's trading range, which is similar to what you mentioned, which we haven't had a 1% change in the market, but the average daily trading range is not talking about the close, but actually the high to the low of the day. That has only been 0.5% in the month of June. Now you compare that to 2014, and the average daily range has been 0.9%, so right now June is roughly half the daily trading range of all of 2014, showing just what kind of low volatility we have. If you back that up and you look all the way back to the year 2000, the average is more like 1.4%. And so now we're looking at June at 65% lower volatility than all of the year 2000. So I think it does mean that this is the calm before the storm. And if you believe in mean reversion, and you believe that the markets are cyclical and that they move both up and down, then I would be worried if I was a bull at this point based on these statistics, not excited about the low volatility.
Chad Karnes, Chief Market Strategist at ETFguide.com, joining us. He does a technical forecast twice a week, covers all the major asset classes, from stocks to bonds to gold and even currencies. Now, you wrote an outstanding article at ETF Guide about how the European Central Bank's latest move, which is basically aping the aggressive monetary policies of the Federal Reserve along with the Bank of Japan, about why that could be bearish for the euro currency. Tell us more.
Yeah, so to believe that the ECB's policies are actually affecting the euro as they want them to, it means you're pretty much living in a fantasy world. That's the way I see it, because in reality, the ECB policy meetings, 5 of the last 6 announcements that they've had have actually sent the euro stronger or higher. So in other words, the market is doing exactly opposite of what the ECB wanted or is implied by their inflationary announcements. The technicals, however, and the charts, they've been and continue to drive the euro's price. That article that you referenced, it can be found on our homepage at etfguide.com, and it includes some charts showing that the euro actually topped way back in 2008, and all the rallies that have occurred since, they've been counter-trend, including the recent strengthening that has occurred since 2012. I think the uptrend is now done, and I think the longer-term technical trend of a lower euro is taking over. Even worse, on a shorter-term basis, this recent announcement, which was June 5th, last Thursday, the euro couldn't even get back above its 200-day moving average. It had a strong day and a strong rally on the announcement, which we expected, but the 200-day moving average stopped the euro in its tracks, and it hasn't looked back and has continued to fall since then. So I think even on a short-term basis, the euro is showing significant weakness, and I think over the next couple of weeks, you're going to get some good opportunities to short the euro, which is something that we're going to be following in our technical forecast looking for some good entries on shorting the euro.
Chad Karnes, Chief Market Strategist at ETFguide.com, joining us. Long-term U.S. Treasury ETFs have been outstanding year-to-date performers and even beating the hot performance of U.S. stocks, but you recently turned bearish. So what do you see ahead for long-term U.S. Treasuries?
Yeah, again, I think this is an example of why the Fed and central banks don't control the markets. As yields, U.S. Treasury yields, they actually bottomed back in 2012 when the 30-year Treasury hit as low as 2.5%. Today it's up to around 3.5%. And since then, even though the Fed had QE and all of its intervention, yields have even, risen, I mentioned from 2.5 to 3.5, but they hit almost as high as 4% earlier in late 2013. Even last summer, someone asked Bernanke about this rise in yields, and he said that they, meaning the Fed, were, and I quote, perplexed. And it just goes to show that even the central bank doesn't know what's necessarily going on with Treasury yields. And I think similar to the euro, on an outlook basis, the bond prices, they have short-term rallied, like you said, year-to-date. But again, they are also in a longer-term downtrend. And I think this recent rally was just another counter-trend move higher. Since 2012, when bond prices topped, charts show that the recent rally in bonds, they've reached key technical resistance points. And you couple that along with sentiment measures that we watch at ETFguide.com, and I think you've got a recipe for a sizable bond top here and a rise in yields down the road.
Gold and gold mining stocks got off to a really good start in early 2014. We saw some of those leveraged gold ETFs, the bullish ones, taking off. But sentiment or market mood towards precious metals over the past few months has been very negative. We've seen a little bit of a retracement in precious metal prices. So what's going on in this particular market?
Yeah, I think the gold bugs are finally realizing that gold and silver are in major downtrends. One of the things I'm watching, and I've shown in our research, is that is the gold to silver ratio. And so what I mean by that is I'm just taking the price of gold, and in this case I'm using the ETF GLD, and I'm dividing it by the price of silver and its ETF SLV, and I'm looking at that trend through time, the trend between the price of gold and the price of silver through time. When this ratio is rising, so when the gold to silver ratio is rising, typically the metals are declining in price. And one of the reasons for that is silver is falling faster than gold, taking that ratio higher. I also have an article on our website at etfguide.com that you can find on gold that shows these charts in action, and it helps put this in perspective and give a little more clarity. But generally, when silver is falling faster than gold, the precious metals are in a bearish trend, and that means that when the gold to silver ratio is rising, the precious metals are in a bearish trend, and this ratio has been rising since the metals topped back in 2011. So that's something I'm watching very closely to see a change in that trend, to warn of a sizable or tradable bottom in the precious metals. Right now, I don't see it. Now, that doesn't mean that you can't take advantage of gold and silver on a short-term basis. That's something that we did in December when we saw a similar setup in the gold to silver ratio, combined with some technicals as well as similar sentiment, as you suggested. Now, and we were able to get long some gold call options, which got our subscribers some hefty 60% plus gains back in December. And I'm seeing something similar right now. I think it might be a little late to the party now. I think the time to do that was a couple of weeks ago, just because I don't think the upside is there. Because as I mentioned, I think that we're still in a longer-term bearish trend in gold and silver prices.
And also another reason why you do a great job at not just watching prices, but also paying attention to sentiment and the market's mood, because typically when it gets extreme in either direction, bullish or bearish, when you see extremes, it usually means that some type of turning point is ahead. We're here with Chad Karnes, Chief Market Strategist at etfguide.com. He does the technical forecast, runs it twice a week, covers all the major asset classes from gold to currencies to stocks to bonds, does an outstanding job. Now, back in November, we had you on the program, Chad. You talked about some of the flaws in the Dow that were hidden from plain sight and the problems facing the Dow committee. and adding in particular 3 stocks that they added at the end of last year. They dropped Alcoa, they dropped Bank of America, and they dropped Hewlett Packard. Can you give us an update about what's going on with the Dow?
Yeah, so let's just put it this way. Since the Dow Committee dropped those 3 companies, Bank of America, Hewlett Packard, and Alcoa, Bank of America is now up 10%, Alcoa is up a whopping 80%, and Hewlett Packard is up over 40%. Combined, these 3 companies are up, if you equate them, around 40% since September. Now compare that to Visa, Goldman, and Nike, which are the 3 companies that the Dow replaced Bank of America, Alcoa, and HP with. Those 3 companies combined are only up around 15% since September. So the companies that the Dow Committee decided to drop have almost tripled the performance of the 3 companies that the Dow Committee added to the index. And, this is something that we kind of expected and something that we talked about. I mentioned it on the previous radio show I was on with you, as well as in our ETF Profit Strategy newsletter from October. I did a big, detailed analysis of the Dow Committee's history and just how horrible they are at picking stocks. And, ultimately what it comes down to is they fall victim to one of the oldest, problems with investing is they tend to chase track records. And so, Visa, Goldman, and Nike all performed very well leading up to September of last year. And, since they've been added to the Dow, though, they are not. And it just goes to show that even the Dow Committee, they don't know what they're doing.
Is it fair to say maybe we should come up with an anti-Dow Committee index? Seems to me like we might have something there. I mean, you want to talk about contrarian indicators that work. This might be a new one.
Yeah, I don't doubt it. I mean, and if you look at some of the analysis we did in our October newsletter, you can see we go back to the 90s and we show, what changes have been made to the Dow and what stocks were added and their performance after they were added, and it's not a good record. And I think you would have come out, significantly ahead if you would have either, shorted those stocks that they added and or just held on to the ones that they got rid of.
Well, great ideas and great interview. Go to etfguide.com and follow Chad Karnes and his technical forecast, which happens twice a week. I'm Ron DeLegge. You're listening to the Index Investing Show, and I'll be right back. Go nowhere.
The Index Investing Show with Ron DeLegge.